Hello, everyone, and welcome to Financial Accounting. Our topic today is internal control over cash. Let's first review what is included in cash. Cash includes coins, currency or paper money, checks, and money orders. It also includes money on deposit with a bank or another financial institution, assuming it is available for withdrawal. Cash is the asset most likely to be improperly used or stolen. Because of that, a business must carefully control cash and cash transactions. Businesses need to control cash from the moment it is received until it is deposited to a bank. Businesses usually receive cash in two ways. First, when cash is received from customers purchasing products or services at the point of sale. And second, when customers make payments on accounts for goods or services purchased at an earlier date. A cash register is an important control for cash received from cash sales. For proper control over cash, businesses must ensure the segregation of duties between employees responsible for handling and recording cash. The American Institute of Certified Public Accountants calls the segregation of duties a basic building block of sustainable risk management and internal controls for a business. Segregation of duties, also called separation of duties, is an internal control designed to prevent error and fraud by ensuring that at least two individuals are responsible for the separate parts of any task. Segregation of duties requires breaking down tasks that might be completed by one employee into multiple tasks so that no one employee is solely in control of a task. Segregation of duties is an essential part of any internal control system. For example, businesses must ensure the segregation of duties between the cashier's department, which safeguards cash and prepares deposits, and the accounting department, which records sales in the company's accounting records. When customers pay their bills, cash is received in the mail. This cash is usually sent in the form of checks. Most companies design their invoices so customers return a remittance advice with their payments. What is remittance advice? The term is derived from the word remit, which means to pay back. A remittance is a document sent to confirm a payment transaction. A remittance helps transparency with invoicing as it offers financial clarity. Remittance advice makes the process convenient because it includes payment dates, amounts, and invoice or order numbers. Remittance allows suppliers to match their open invoices with incoming payments easily. The purpose of the remittance advice in control over cash is to serve as a record of the cash received. It also helps ensure that the posting to the customer's account is for the amount of cash received. The employee opening the mail compares the cash received with the amount shown on the remittance advice. After that, stamped checks are delivered to the cashier's department for depositing into the bank. The remittance advices and their summary totals are delivered to the accounting department. The cashier's department then returns a stamped duplicate of the deposit ticket to the accounting department. This control helps ensure that all cash is deposited and no cash is lost or stolen on the way to the bank. Any shortages are, therefore, promptly detected. Let's also look at situations when payments are delivered electronically. Since so many people now work remotely, electronic payments have become very popular, and many customers prefer to send funds electronically. An electronic funds transfer is the process of moving money from one bank account to another using computer-based technology. EFT removes the need for paper transactions, such as paper checks. EFT is merely the digital way of transferring funds from one bank account to another. This process is known as electronic banking because it allows businesses to move money electronically. Since the transaction doesn't involve any materials exchanging hands, the process doesn't require in-person interactions with banking employees. An EFT could be initiated on a one-time basis by the customer, or the customer could authorize the company to transfer the funds automatically for regular monthly payments. Customers may authorize EFTs from their checking account directly to the company's checking account to pay monthly bills. Electronic fund transfers are a secure, efficient, and less expensive alternative to paper checks. One example of an EFT that most people are familiar with is direct deposits, when employers deposit payments directly to employees' bank accounts. The company records the electronic transfer as a receipt of cash to its bank account and posts the amount paid to the customer's account. The cost of EFTs is less than receiving payments through the mail, and receiving payments electronically also speeds up the processing of cash receipts. Additionally, EFTs improve internal control by eliminating the requirement for any employee to handle cash. Now, let's talk about payments. Internal control over cash disbursements should provide reasonable assurance that payments are made for only authorized transactions and that cash is used effectively and efficiently. A voucher system is often used to control cash payments. A voucher system is a set of procedures for authorizing and recording liabilities and cash payments. A voucher may be used as a special form to record data about liability and the details of its payment. An invoice that is approved for payment could also be considered a voucher. Like any other payment, electronic payments need to be subject to appropriate internal controls. I will discuss the best practices for electronic payment controls in a separate video. I hope you found this video helpful. If you did, please make sure to subscribe, hit the like button, and ring the notification bell so you are notified when we release more videos like this. Thank you all so much for watching, and I hope to see you all again in the next video.